Tell me what you look for in an underlying business.
Well, American businesses probably have single-digit net margins on average. And the returns on equity, returns on the owner's capital, as I suggested, are probably in the low teens. So if we find a business, as we're looking around, that has returns which are significantly greater than that, that causes us to get curious about, well, why is that occurring? And so the simple reasons would be they have patent, or they have the absence of competition for one reason or another.
That's the moat.
Right, that's the moat, the frequent phrase that's used.
Warren Buffett and
right, and
Ben
sometimes in a business we say, well, we don't know precisely why they're able to do it. This is what we think. And that's okay too. We've learned to get comfortable with that. And
not being quite sure, but
right,
you just know they're doing it.
This is what our hunch is. Managements, if it's something that's really a secret sauce, the managements are unlikely to share it directly with us because it invites competition. And if you have a business with very high returns, it will naturally invite competition. Everybody wants to get something that's got better returns than they have. And so, that's how we go about it. And we spend a lot of time trying to study other companies in that line of business or other businesses that are related and make our judgments that way.
Can you give me another example? I'm looking at your top 10 holdings,
Yeah.
Colfax, Moody's, Mastercard, American Tower, Dollar Tree, Visa.
So some of them are quite easy to talk about. American Tower, for example. They are essentially the largest worldwide in the business of erecting towers in which support antenna for wireless communications.
Big, growing business globally.
Right, and so it's a vertical business. The model is more towers, more tenants per tower, and more rent per tenant. And on the last item, their contracts with the carriers typically have escalators, annual escalators built into the contract. So every year they're going to get 3 or 4% more for that same service. In addition to that, as we've gone from what they call 1G to 2G to 3G to 4G and so on in our handheld sets and stuff, each of those requires actually a denser tower network because they require a greater level of complication, as it were, in the antenna, that sort of stuff. And so each of those greater density requirements requires more towers and sometimes alterations of the antennas on the towers and that sort of stuff. And each is a profit opportunity for American Tower. So it's a very protected business. And then in the last half a dozen or more years, they've been growing extensively outside the U.S. and are in 11 different countries as well as the U.S. And so, very protected. You can see why they get high returns on their assets. On the other hand, if you take business like Mastercard or Visa, it's much more difficult to figure out exactly why they have such high returns on the capital, and the returns are enormous. They are unable to invest in other businesses that have returns that are as high as theirs. So
what a problem to have.
What a problem to have. And so they still have to do something with the enormous amount of cash they generate. And what they've done is they've instituted a small dividend that they grow. They've instituted some share buybacks of the last couple of years where they're buying back billions of dollars of stock. But they still end up with lots of extra cash. And that's a little bit of a dilemma. It makes the compounding a little bit more difficult because they're not reinvesting. So they buy small businesses that help them with advances in mobile technology or whatever else. That's mobile payments, all of those things. But they cannot make large investments that in businesses which have those high returns.
It sounds like, therefore, their sustainable model years in the future might be more difficult than it is than for an American Tower.
It might be, but there's a ubiquity of acceptance of a Mastercard or a Visa card around the world. It continues to grow, and their business model is such that they get paid not only on each transaction, but they get paid on the amount of currency in each transaction. So it's really a wonderful inflation hedge. That is, if currencies get devalued and the dollars involved in a transaction go up, they get more money out of it, that sort of stuff. So it's a really fascinating business model.
You also have, I think, what you call your workbench companies.
Right.
They're almost like workouts as far as you're concerned. Could you share one of those companies with us?
Colfax was one of those, and it's our largest holding these days, but we started with it in a very small piece, and we were attracted to it for a number of reasons, including what their business plan and model was.
Which is?
They acquire other industrial companies, and through a technique of their own that is based on a Japanese Toyota manufacturing model of continuous improvement, they rationalize these businesses dramatically. And so they source and buy underperforming companies and buy them and improve them and dramatically increase the rates of return.
Do they then sell them, spin them off?
No, they don't. They keep them going for the most part. And the company was founded by Mitch and Stephen Rails, who had also founded over 30 years ago a company called Danaher, where in Danaher they compounded the shareholders' capital at 20% a year for 30 years. I mean, and so we're attracted to that. We're attracted to that way of thinking. They're both significant shareholders and are behind this business. And so in one sense, it's sort of, we thought maybe it's a Danaher Redux. And we got started as a small company, and then we went to visit them, and we've been to visit them again, and so on, and watch how they performed with their acquisitions and see how things are going. So that's an example.